investment target selection, and risk management. How Buffett evaluates companies, avoids pitfalls, and protects partners' wealth. Introduction. Investing is not risk-taking, but a rational choice. In the previous lecture, we learned about establishing a partnership mindset and understood how Buffett treats each shareholder as a business partner, operating Berkshire Hathaway on the foundation of trust, transparency, and long-term win-win cooperation. However, to truly fulfill promises to partners, a philosophy alone is far from sufficient. How to select trustworthy investment targets and how to protect wealth from being devoured by risk are the core and most practical lessons in Buffett's investment system. In the market, too many people equate investing with speculation, viewing volatility as opportunity and high risk as a necessary path to high returns. But Buffett's decades of performance tell us that truly great investing is not about making a lot of money, but about losing little. Not about chasing trends, but about choosing reliability. Not about embracing uncertainty, but about proactively avoiding danger. Today, let's delve into Warren Buffett's investment world, learning how he evaluates companies, selects targets, and systematically manages risk. To understand risk before returns, Buffett's view on risk. Many people equate risk with volatility, viewing large fluctuations in stock prices as high risk. But Buffett completely overturns this notion. He believes that real risk isn't stock price volatility, but rather knowing nothing about a company, buying assets destined to fail, spiral out of control, or collapse. Risk stems from uncertainty, from business models you don't understand, from the future you can't predict, from unreliable management, from chaotic industry structures, and from falsified financial data. For Buffett, protecting his partner's principal is the first principle. He often says, the first rule of investing is never lose money. The second rule is never forget the first rule. This isn't just a slogan, but the underlying logic of his investment choices and risk management. All investment activities are based on the premise of preserving capital before pursuing reasonable and sustainable returns. 3. How to evaluate a company. Buffett's select people, understand business, calculate accounts principle. Buffett's selection of investment targets is never based on stock charts, rumors, or chasing trends. Instead, he selects them with the same rigor, meticulousness, and even harshness as choosing a business partner. His evaluation system can be condensed into 3 core dimensions. 1. Looking at management. Reliability is more important than intelligence. Buffett repeatedly emphasizes that investing is about investing in people. He prioritizes honest, upright, capable management teams who prioritize shareholder interests. If management is selfish, short-sighted, prone to siphoning off company assets, or lacks transparency with shareholders, he will reject the investment regardless of the company's seemingly lucrative business. In his eyes, an unreliable company, no matter how high its growth or how dazzling its concepts, is high risk. Only trustworthy managers can safeguard the company's value in the long term and live up to the trust of partners. 2. Looking at business model and competitive barriers. Simple, easy to understand, difficult to replicate. Buffett only invests in businesses he understands, the so-called circle of competence. He prefers companies with simple operations, clear cash flow, and strong competitive advantages such as brand strength, cost advantages, network effects, and patent barriers. These barriers can deter competitors and allow the company to maintain stable profitability over a long period, rather than being eliminated at any time in fierce competition. Conversely, companies with complex operations, rapid changes, reliance on a single technology, policies, subsidies, or unsustainable dividends even if they experience phenomenal short-term growth, will be excluded by him. This is because higher uncertainty means greater risk. 3. Financial analysis and valuation. Calculate value. Wait for a good price. After assessing the company itself, Buffett looks at its financial data, stable profits, ample free cash flow, low debt, and high return on equity, not growth fueled by debt. At the same time, he insists that good companies must also have good prices. Even the best companies become high-risk investments if their valuations are too high or the bubble is too large. He prefers to wait for the market to fall and for a reasonable price to appear, rather than chasing high prices, using a margin of safety to build a safety net for his partners. For proactively avoid high risks and uncertainties, Buffett's negative list. Half of Buffett's success comes from choosing the right things to do, and the other half from resolutely avoiding certain areas. He has a clear list of pitfalls, which is also key to our risk management. Avoid industries and businesses you don't understand. Stay away from tech bubbles, complex derivatives, incomprehensible financial structures, and overnight sensational concepts. Don't invest in what you don't understand. This is the lowest cost risk control. Avoid highly leveraged companies. Leverage can amplify both returns and losses. During economic downturns, highly leveraged companies are highly susceptible to cash flow problems, causing devastating losses for shareholders. Avoid industries without moats and extremely fierce competition. Businesses without barriers to entry can be profitable today, but could be disrupted tomorrow. Profits can drop to zero at any time, resulting in extremely high uncertainty. Avoid companies with dishonest management and a history of misconduct, financial fraud, related party transactions, frequent share issuances to raise funds, and disregard for the interests of minority shareholders. Don't touch these companies, no matter how cheap they are. Avoid highly speculative targets whose stock prices are detached from fundamentals and driven entirely by emotions and capital. This is not investing, it's gambling. Buffett consistently adheres to the principle, it's better to miss an opportunity than to invest in high-risk, highly uncertain targets, because being responsible to partners means being responsible for every penny of their hard-earned money. Beat the core of risk management, circle of competence, margin of safety, and diversification logic. After determining investment targets, Buffett's risk management doesn't involve frequent trading or chasing highs and lows, but rather relies on 3 fundamental tools. First, adhere to your circle of competence. Only make decisions within your understanding. Don't do what you don't understand, eliminating the risk of ignorance at its source. Second, maintain a margin of safety. Buy at a price below intrinsic value, leaving a buffer for misjudgments and market fluctuations. Third, rational diversification, not blind diversification. Buffett's diversification involves diversifying into high-quality companies across different industries and with different underlying principles, rather than holding a large number of mediocre targets. Appropriately concentrating on high-quality assets is more effective in controlling risk than excessive diversification. Meanwhile, he holds stocks for the long term, reducing trading to avoid the costs and market frictions of frequent operations, allowing time to be a friend of good companies and an enemy of risk. VIA conclusion: risk control as the bottom line, value as the goal, and responsibility to partners. From the partner philosophy discussed in the previous lecture to today's investment target selection and risk management, we can clearly see a main thread. All of Buffett's investment actions are essentially fulfilling his responsibility to shareholders. Choosing high-quality companies is for the steady growth of wealth. Strictly controlling risks and avoiding traps is for protecting the principle of partners. Avoiding speculation Risk-taking and following the crowd is for long-term credibility, reliability, and sustainability. Investing is never a thrilling adventure, but a rational, serious, and long-term endeavor. By learning to evaluate companies, select targets, and mitigate risks like Buffett, we can truly achieve peace of mind amidst market fluctuations, steady progress on the long road ahead, protecting our own wealth, and living up to every trust and entrustment.